Okay, afternoon folks. Today we're going to start talking about the notes to the accounts in published accounts questions. And I'm going to deal with the 2008 and 2006 questions, and I'm going to start with the 2008 question because the notes they ask you to prepare there are the more usual notes in the usual order as well. So we're going to start with that, and you should already have the trading account already done, or the profit and loss account, and we're just going to look at those notes. And so the notes we said already are basically, they're just extra little explanatory notes that come after a set of accounts because some of the information in the accounts might not reveal everything that the person who's reading it wants to know about the accounts, so they might need a little bit more information. So first thing to notice here, let me just get a pen to point here. They ask you for, in this particular question, and it's not always these five, it's usually either 4 or 5 notes that they ask you for, and it could be any of, if you've read the stuff that I asked you to read in the chapter, it could be any combination of 5, but there are usually like 3 or 4 that come up almost all of the time, really. So this is a typical sort of set of notes that they're asking us for here. One is accounting policy note for tangible fixed assets and stock. Okay, that comes up almost every time. 1 sec. Okay. Just skipping down to number 5 is tangible fixed assets. So it seems like it's the exact same thing, but just be careful because they sound so similar. The accounting policy note for tangible fixed assets and stock is more wordy, really. It's words describing your policy for valuing stock and depreciating your fixed assets. Whereas number 5, where they just ask for tangible fixed assets, that's more figures. So you're showing exactly how much depreciation you wrote off, and if there usually is a revaluation, how much the revaluation was. So it's pretty much all figures, whereas the accounting policy note for tangible fixed assets and stock is pretty much all words. Operating profit, that would be a straightforward regular one. Financial fixed assets, not as regular as the first two, but quite regular. Dividends comes up quite an awful lot as well in the tangible fixed assets, almost every time as well. So this would be a good one to start on. So let's look at the tangible policy, or the accounting policy note rather, for tangible fixed assets and stock, number 1. Now I'm going to just show you the solution on the computer screen, and I hope this works all right rather than having to write it all out again. So just to explain, there's 4 marks going for it in this case. Normally 4 to 5 marks is what I've seen given in this for this note, and usually there's no marks going for this accounting policy notes. I wouldn't even bother with that heading. Tangible fixed assets, yeah, put in the heading definitely, but there's usually no marks going for it. Okay, this is a standard sentence that you must say. Only if the buildings were revalued, but I've never come across a published accounts question where they asked you for this note and the buildings hadn't been revalued. So buildings were revalued at the end of 2007 and have been included in the accounts at their revalued amount. You've got to learn that sentence off by heart and say it exactly as it is. The only thing you change from year to year is whatever this year is. This is for the 2008 question, so it's based on the year, the set of accounts for the year 2007. So if you were doing this question in 2019, you'd probably have 2018 written in here, but the rest of the sentence would be the same. Okay. There's usually there's another short line that goes in after this as well. It's about the vehicles being included at cost price, but we'll see that in another example in a while, but I would always put that in also. Normally 1 mark for that. This sentence, depreciation is calculated in order to write off the value or cost of tangible fixed assets over their estimated useful economic life as follows. There's usually a mark going for that. And just explain some of the words, because it's easier to learn these things off by heart if you understand what the words mean. So we know what depreciation is. So it's calculated in order to write off the value or cost of a tangible fixed asset. I think we know all of those words there. Over their estimated useful economic life. Over their estimated useful economic life is their however many years, I suppose, that we think they'll be of any use to us before they're scrap or absolutely no value. Okay, so their estimated useful economic life as follows. So again, this is, you put in whatever is relevant to the particular question, but I think every single question I've ever seen, it's been 2%. So you put in buildings, 2% per annum, straight line. I've never seen that being different. Delivery vans, whatever the percent in the question is, but often it's 20% as well. Delivery vans, 20% of cost. An odd time you'll see, you might see something like reducing balance if it is the case, but almost always it's this 20% of cost. Okay. Next thing, this is, so you get usually 1 mark, 2 marks, 3 marks, 4 marks, 5 marks. Okay, I know there's only 4 in this case, so they've obviously not given marks for one of them. Last line then, again, you have to learn this off by heart. Stocks are valued on a first in, first out basis at the lower of cost and net realizable value. So what that means is, we've already looked at the first in, first out basis. It means whatever you purchase first is the first thing that you should be selling, and that's what you regard as having been done, even when you have identical products in your warehouse. And they're valued at the lower of cost and net realizable value. Well, what that means is that if you, for instance, if you're trading in shoes, if you had a pair of shoes and you bought it for €20, well, that's the cost value of those shoes. And normally, when you include that in your stock, you would include it at a value of €20 because that's what you bought it for. However, if it turns out that those shoes were damaged in some way, they were on display maybe and they faded in a display window or something like that, and you could not even sell them for €20, the best you could hope to realize for them is €10, then the net realizable value is the net amount that you could sell them for is €10. Well, if cost is 20 and the amount you could possibly sell them for is 10, then you must value them at the lower of the two of them, and the lower of the two of them would be the net realizable value, which is €10. Okay, so you must, because of the accounting concept of prudence, not to overvalue things, you must value them at the lower of the two, whether it's cost or net realizable value. And it could go the other way around, I suppose. If you were in something like the antiques business and you bought an antique for €100, and then after a few years you figure it's worth 120, you could sell it for, or if you had to purchase it in the future, I suppose it costs 120, you'd still value it at the lower. It'd be €100. Okay. So again, unfortunately, I don't like to see you learning stuff off by heart, but you have to, because they're just looking for these exact words in this accounting policy note. Okay, the next one, operating profit, comes up all of the time. There are usually it's always the same 4 things that come in here. I've only ever once seen something else in this 5th item, and that was solicitors' fees, but it was in a pre, and I've never seen it come up besides that, or I think it was a pre paper. So just one thing to note, there's 2.5 marks going here. I would be pretty certain that that was half a mark for this line, half a mark, half a mark, half a mark, half a mark, okay, to get to the 2.5. Is that, how many is that? 1, 2, 3, 4, 5. That's 2.5. So usually nothing for the heading again. Half a mark for this. The operating profit is arrived after charging, so please learn that off by heart. This depreciation tangible fixed assets figure is, that's the depreciation that you would calculate on both your buildings and your delivery vans, and you just add the two of them together to make up this figure here. You don't put them in separately, just one figure here added together. Okay, the patent amortized, you've worked that out already when you were doing your profit and loss account, put in the figure there. Director's remuneration, that was in the in your administration expenses, so we must put that in, and same with the auditor's fees, put it in, and that's it. No need to total them or anything like that, just list them out. Okay, financial fixed assets. So this is a big one. I suppose this comes up pretty often. It's any investments you have, whether they're quoted or unquoted. Now, when we say quoted and unquoted, you will know whether they're quoted or unquoted because they'll say it in the actual trial balance. They'll say quoted investments in the trial balance, and they'll have it, since it's an asset, they'll have it on the debit side of the trial balance at some amount. Unquoted investments, they'll have it in the trial balance at some amount. So it's just a matter of taking that information and writing it down in here. Now, excuse me. whatever, I suppose, the amounts that are in the trial balance at these dates, you just put them directly in here. However, you may have in brackets underneath the, let's just go over and look at the question actually so we can see it. Over here we have quoted investments, unquoted investments. So you know they which are which because they list them or they label them perfectly. They give you the 200, they give you the 60. You put them in as being the exact same at the start of the year and the end of the year. If I look at it here, your two columns, start of the year, end of the year. The only reason they'll change is if they mention somewhere down here how they sold some investments or bought some extra investments during the year. But I don't think outside of pre-papers I've ever seen that happen. And so then they'll give you in brackets here these figures of what the quoted investments are worth today on the market, or what they estimate they're worth today on the market, and what the unquoted investments are, what the director values them at or thinks that they're worth. So you must include these in just 2 lines underneath here as well, and you'll get your full marks there. Now 2 marks for that. I can only imagine it was something like half a mark, half a mark, half a mark, half a mark to get the full marks there.